The following is for entertainment purposes only. We are not financial advisors. We are not responsible for any losses, only the profits. What's going on, Octo Nation? We had a conversation stir up, and I think it gave me a great opportunity to make a video. So here we are. Value is like beauty's eyes, beyond the beholder. Plain and simple, can't be denied, numbers cannot lie. Mr. SPAC King, Julian Climachoco, dude is on Twitter. He's all over. He's guys on podcasts. You should listen to it. This guy's good. He calls himself a SPAC King on Twitter. There's a link here down in the description if you want to take a look and follow him. He came out and posted this article a couple days ago. He said, the worst year for value investing of all time. So far in 2020, large U.S. growth stocks have beaten big value stocks by 36%. That shatters all records. The widest such margin in a previous full year was 26% in 1999, which was right before what? Big dot-com bubble? Maybe, yeah. This was an article written on Wall Street Journal. You can check that out and read that if you want. It started out by saying, our recent performance sucks. Here's your $10 billion back. A value investor who is used to having a great record just called it quits. Maybe that means bargain hunting for stocks is about to make a comeback. I don't know. Let's see. And so that's when I replied to him saying, if you're under 40, value has underperformed for the majority of your career. This is very true. And then I put, plain and simple, cannot be denied, numbers cannot lie. One of our subscribers wrote and said, hey, can you please elaborate on that? I thought, you know what? Maybe this would be a good time to make a video. Value investing versus growth investing, value investing in stocks. This is kind of what it's like, especially for the new generation, or maybe a lot of our subscribers who are used to stuff like SPACs. This is exactly what I think of when I think of value investing in stocks. I just want to take a nap. I just don't get it. How to tell if you're stuck in the value mindset. This might help paint a picture of what it's all about. You only invest if profit to earnings ratio, PE ratios, fall between the average of the dividends aristocrats. You only invest in aristocrat dividend stocks. If you don't know, those are companies who have paid and increased their dividends for the past 25 years straight. Nothing wrong with those. Nothing wrong with them at all. Maybe I'll point some out in a second. At face value, that seems like a really good thing to have, right? A company that's increasing your dividends for 25 years and all that. But of course, every sword has more than two sides and blades that can cut you. You worship and quote daily Warren Buffett and refuse to take any other investment advice. That sound like you? I think we all have a friend like this, right? No matter what. Warren Buffett said, here is a fun chart of the SPY, the salt and pep of 500, and Mr. Buffett's Berkshire Hathaway, which ain't all that bad. Why? Because take a look at this. So this red line down below with the dots all in it, this is the S&P 500. In the past, well, let's call it 23 years, it has gone up 428.92%. That's fine, but not really that good in that amount of time. Berkshire Hathaway, though, behind it, boom, boom, boom. Look at this. Berkshire has actually done 786.29%. That seems pretty good, right? I think it is. The PE ratio of the S&P 500 is currently, the average is sitting at 34.92, which might seem kind of high to some people. Maybe not people in SPACs, but the PE ratio of Berkshire is currently sitting at 21.79. Keep that in mind. Keep in mind that Berkshire is not 100% chosen stocks by the Yoda himself either. A lot of people think that. They think that Berkshire Hathaway is just like this investment fund that just buys stocks. Not even close. And not all are considered value stocks that they place money in. Did you know that they own a bunch of businesses? The company wholly owns Geico, Duracell, Dairy Queen, BNSF, Fruit of the Loom, Long & Foster, Pampered Chef. It keeps going. How about Kraft and Heinz? They own at least a majority of that. Well, not majority, but 26.7%. quite a bit, right? 9.32% of Coca-Cola. Keeps going on and on. They've also been big in the airlines, though. Keep that in mind. Other characteristics of value stocks might be super strong, proven mechanics, proven through multiple fiscal years. What I mean by that, just they've got a line it's going up, but not usually like this. It's going up kind of like this. You know, maybe the stocks people talk about where you can park your money and sleep well at night. So a lot of people think. With them, cash flow is king. I don't think you could find any big investor that could argue this blatant statement right here that cash flow is king. Cash flow is king, pretty much across the board. No matter what kind of business or money moving you're in, cash flow is king. They might carry less, sometimes perceived risk versus other investments. And again, people think they can sleep better at night, but it's not always the case, especially not nowadays. On a usual conservative, mild sale, like let's say 2 to 6% off is when they're bought. So what do? They try to get companies that have proven all along the way. When they get maybe 2 to 6% off, they start salivating a little bit and be like, oh my gosh, I'm going to get a really good deal right now. I'm going to get a really good deal and get this 2 to 6% off. It could be good businesses run by good people at reasonable prices. That's another way to sum it up. Cons of value stocks. They can still tank like other more risky stocks. That's one of the major problems, don't you think? You can't necessarily sleep better at night. Maybe, but not in this market. Not with forced closings of stuff like, restaurants and airplanes and stuff like that. How are you going to sleep at night with that stuff going on? Many people are proud when they lose money compared to real 1980s, 1990s non-luxury inflation. I've brought up inflation before and you get scolded down in the comments where people are like, oh, I Googled it and it said inflation only like 1.13%. You said it was close to 7. There are different ways to look at inflation. There are different calculations. The one that has been used more recently and is being used in the macro picture of a lot of things, in my eyes, it is kind of just too much. Why? Because they include things, frivolous things, like luxury items, such as window coverings. When was the last time you bought window coverings? I can't tell you the last time I bought window coverings. All right. Back in the 80s, it was way more conservative. Back in the 90s version, it was, let's call it moderately conservative, where they're not going to include things like the high-end window covering prices adjusted to inflation rate. Things like even luxury, like fruits, like let's say dragon fruits or something like that. Do you think that like dragon fruits or like a high-end grapefruit or something like that should be included in inflation ratings? I don't think so. I think it should be the bread and the butter, the gasoline, the house, that type of stuff. So if we are going off the 1980s and 1990s, you can take a look at these graphs I put for y'all here. The official CPI is this ketchup and mustard down here. And above it, you've got Mr. Prince himself in the purple, and you can see it's bouncing around maybe 5-ish% currently right this second. But then we got off the 80s. Okay, that was off the 90s. Now we're going off the 80s. Now we're looking where inflation is at. Inflation is like at 9%. It's been way above it compared to the ketchup, which is the current showing, just over 1%. When was the last time you were at the grocery store and looked at the price of meat? Everywhere I've looked, it's like 2x. Even fruits and vegetables are way higher than they were 6 months ago. And I really think that with the new regulations and all that, it's going to kind of continue that way. Everything across the board, the prices are going to be going up. All the stuff with China. So what did I mean coming full circle with this? Many people are proud when they lose money compared to the real luxury inflation. I see people online all the time talk about they've got, an account where they're making maybe 4 or 5% a year and they're kind of happy about it because it's safe and they can sleep well at night. What they're not realizing is they are losing money. Me, if I am losing money in any account, even though I can sleep at night, I am not happy. I do not want to be losing money versus inflation. To me, that's just pathetic. Many get stale because of too much risk in changing the way things used to be. They think going after, big growth companies is just too risky. But as that article from Wall Street Journal was trying to point out, I don't think that's really the case anymore. But a lot of people are just stuck in that mentality. Dividends keep growth dismal. Not saying 100%, of course, but a lot of times they do because they get bled out. I talk about that a lot. Like, people even ask me, like, what are the best dividend stocks to get in? I'm like, don't ask me. I'm not the guy to ask about dividend stocks, man. I could probably name some. I might even name some here in a little bit, but I am not the guru for the dividend side of things. Why? Because they keep growth dismal. Because they know that if they don't keep increasing the dividend amount, people are going to start jumping ship. Jumping out. I like getting into more the growth side of vehicle companies because they're taking that money they could have put out to dividends and they're buying more businesses, taking over more things, going to more states, more countries, taking over, getting more macro in their thinking, more global, more bigger. I'd rather be investing in a company that's going huge all in than one that's like, okay, we're kind of peaked, we're just chilling here. Coal suppression, ESG suppression, green suppression could hurt and will hurt many value stocks, a la railroads and oil. It's a good example. A lot of value stocks are things like that, the old school stocks, right? Boy, it'd be good to own a piece of the railroad, don't you think? I don't know, man. What if coal starts getting even more and more suppressed? What's going to happen? The railroads could go, your stock that your granddaddy passed down for generation after generation might end up going down real fast. Especially if we get, someone in leadership that really just ixnay's coal or something. Even though I've talked about it before, there are ways to suppress the emissions of coal. You can simply just place something on top of the emission stack and it cleans it. But just something to keep in mind. You're not totally safe when you're in these. When do you buy value stocks? When maybe this is a good thing to do? When someone sues them over coffee being too hot. I remember that. When was that? Man, the late 90s or something, when like every other day it seemed like you turned on the TV or something and other restaurant was getting sued because of hot coffee, and then what happened to the stock? It went down. So why would that be a good time to buy it at that point? Because nothing has really changed with the business at all. It's still going to be it's still totally valuable. It's one time they get sued, big deal, right? That's when a lot of value people will kind of look in, like when there's a slight bit of bad news, as long as no fiscal dynamics have changed, the business itself isn't gone, right? There's nothing that's like butting it out of the way. That's when they're going to get it the 5-ish% off and be like, oh yeah, I'm going shopping, baby. Another way I put it is, this is a never going to go anywhere lawsuit. And what I mean by that, there's lots of lawyers out there. If you're in SPACs, for sure it happens now. You should at least, that they get sued all the time. You can sue anybody you want. One of the best things about America is its endless appeal system. And I guess you could sue anybody for whatever you want. It doesn't mean that anything is going to hold any sort of weight in court, though. So what am I getting at here? A lot of these lawsuits are never going to go anywhere. If it's like a hot coffee lawsuit, that's probably going to get thrown out no matter what. Or, maybe they'll give the chick $10 million and be like, okay, we're still going to be making hot dogs and hamburgers, okay? People are still coming even though we spilled coffee on one chick. when it gets on MSNBC that, they're getting sued because of this and yada yada, as long as it's nothing too crazy, that's a good time to buy. When you are super long a company that you deem moated, basically no one can touch them. They kind of own the channel and are bulletproof. You can get super long on a value, look at something as a value stock. How about some examples of value stock? Well, good old Coca-Cola, P/E ratio 26.2. Look what this has done in the past 10 years. Can y'all guess? It's gone up 76.7%. So, based on our calculations from the graph above, from 1980s and 90s, I think you're losing money. Can anyone calculate that? 76 divided by 10? Does this look like a stock you want to get in? Not me. Check a look what happened in March. You could have got this thing for over 70% off, 80% off. So could you sleep well at night in March if you had a nice value stock like Coca-Cola? I wouldn't be, because I would have been out, but I would have slept really well if I would have bought it down here though. Right? If you can buy, so I'll buy a value stock if I can get it almost 100% off, 80% off. Yeah, I'll buy some Coca-Cola then. But do you think I want to sit here for 10 years and make 7.67% a year? Oh wait, and inflation's higher than that? Oh, so I'm losing money? This seems terrible to me. How about Union Pacific Trains? Choo-choo. UNB, 23.98 P/E ratio. What has this done in the past 10 years? It's gone up 486.29%. It's done quite a bit better than the one we're just looking at, right? Still though, you're 5x your money, it's 50%, blah, blah, just calculate it. But again, just look what I'm trying to point out here in March. Look what happened. Got cut in half. Can you sleep at night then? What about right here? What happened here? In 2014, why did this go down? This is terrible. It got caught in like more than half. Got cut more than half off. So is this better than Tesla or Amazon? I don't know. This one is up for debate, I guess. All these are. But United Airlines, UAL, P/E ratio of 9.85. Wow, that's this most guys would be all over this if they're in the value, right? Low P/E ratio. It's the airlines. What could happen to the airlines? Oh, that could happen to the airlines. So, I mean, this was, to be fair, this was up 600% in 10 years. Not bad, okay? But look what happened in March, man. Can anyone see this? This went from 600% up down to only 40% up. So you lost all your gains if you sold out right back down here for the past 10 years. Look at these other big dips it's had. Mr. Buffett has claimed that he thinks that this is a growth stock. He's saying that because to him, this is as growth stock as he's claiming he wants to get. To many people, this is nowhere close to a growth stock, where they're taking massive profits and instead of giving it back out or just chilling, they're trying to always like get into weird other different things, other little airports, things they're not profitable on. That's why he doesn't like it, because if they would have just stuck to what they knew the past decade, they would have been doing a lot better as far as what he says. That doesn't mean it. Just according to the P/E ratio. Just call that. According to cash flow and the P/E ratio. A good example too is McDonald's. I don't know the exact numbers off the top of my head, but I was reading an article, 5 or 10 years ago, where ever since they started getting to like the McCafe lattes and like the Dippin' Dots stuff and the weird side stuff they started selling, their profits started tanking. Right? Because they're like, well, we can be a Starbucks too. Why can't we be a Starbucks? We're going to be a Starbucks number 3. They haven't made any money on it. So that's what he's getting at there, is sometimes businesses, if you're known for being the best hamburger in the world, just keep making the best hamburgers in the world. I don't know if they're made, I don't know if they're known, anyone really thinks they're the best hamburgers in the world, but you get what I'm saying. If you're known for hamburgers and fries, just be known for that. Growth investing is what we're moving on to now. Let's get into real growth investing. It could equal businesses' life cycles that never seem to end. They just keep trying to go up. They just never stop. 20% or more expected growth in the next year usually shows that a company is looking more like a growth stock. If they're looking to go up 20% or more over the next year, that's growth. And that's where some of the value guys get scared. But not me, because to me, this is like my minimal threshold. If I don't think that I can make at least 20% on a stock in 1 year, what's the point of being in it? That's the way I look at it. Always adding more exciting avenues and products. Doesn't that sound exciting? It does. And you can definitely get carried away. I mean, I'll just have to use Tesla as an example because they're probably the most blatant that people know about. You realize how crazy it is that we went from like electric cars to spaceships? And now he's talking about like manipulating brains for neuroscience. This is what scares value investors. As they look at the growth stuff like Elon, like this guy is nuts. His stock might be going up, but is this a car company or is this Neuralink or what is this? But I think the majority of people look at this like, this is cool. I want to invest in all these things that he's trying to do. It's just mirrors. Everything he touches pretty much worked out. Why do you think that is? But why are growth stocks always outperforming value investing stocks? Because they fill in the cool factor. No matter what, people want to feel cool. Is the Ford Mustang the best-selling car that Ford will ever have? It just might be. Why? Because people at least want to be cool. Even if they can only get the 4-cylinder or the 6-cylinder, at least they look cool. It looks the part, right? And they're just so exciting. I think it's exciting. Like, do you want to invest in a train that delivers boxed utensils for restaurants, or do you want to invest in a spaceship company or a super rad car company? Now we're rocking. Think FANG stocks, all right? You know, Apple, Amazon, those type of things. Amazon here got a PE ratio of 123. Red flag for most value investors, but check out what this has done in the past 10 years. 2,299.94%. Let's just call it 2,300, 2,400, 25, almost 2,600% it has reached at its all-time highs. To me, just looking at this chart, it looks way less volatile than the ones we're just looking at. What happened to this in March? Not much. It only went from 1,500% down to, let's call it 1,100%. The other ones were getting cut in half, plus. The value stuff was getting cut in half, plus. This barely went down. This, just by charting, man, going on all this. How is Amazon ever going to fail? If you can't answer how a company will ever fail, that's that moat. How could Amazon ever fail? I don't know. Think about Chipotle. This one could be looked at both ways. I'm definitely going to call it a growth company, though. Why? Right away, I know the value guys will see a 160 PE ratio and run. Chipotle Mexican Grills. Does anyone eat there regularly? CMG, one of the best faster fooder places you can go to, in my opinion. At least it's real meat, not a byproduct. What has happened to this stock? Well, it has gone up about 1,500%, let's just call it. What happened in March? This thing got hit pretty hard. You know, it went from 1,000% down to 460% off. You could have gotten it basically of where we're at. Let's just call it that. But regardless, look at the percent this is up. This is big news. Mr. Warren Buffett has said growth has been detrimental to the airline business. More and more capital has been put into it with inadequate returns, but has been great for companies like See's Candies because it requires relatively incremental investment to sell 2 pounds more of candy. Maybe the chicks up front could change one piece of wording and end up selling 2 pounds more of candy a day. So what he's getting at? I think the airlines could have easily done something like that too. I don't know. Maybe you can also look at it like maybe the airlines just weren't aggressive enough. They weren't using the growth in their mind enough. Maybe they should have like gone in and bought another airline. That would have really changed things. But then again, what would have happened in March? I'm sure they could just keep getting bailed out by the government else, but you know, growth and value are definitely two different categories. I actually cringe when I hear people talk about which type of stock should I buy now, either value or growth stocks. It just doesn't make any sense. Growth investing is just a part of value investing. Again, this is out of Mr. Warren Buffett's mouth in a sense, but he's not, I just don't think he's getting it, man. I don't think he gets it. You could argue that growth investing is part of value investing, but we're trying to split this up. That's why this exists. So you can kind of have the yin and the yang of investing. And if it really is all about numbers, like he so often states, shouldn't he go after more growth or figure out what growth investing really is? Because value hasn't done very well past 2 decades. Compare it to growth. Point is, lots of companies' PE ratios are always going to be out of whack. Always taking every dime and reinvesting it into the business for growth. I believe that. Stuff like Tesla with a 1,082 PE ratio. That's how nuts that is. By all fingers and pointing, there is no way this could be a value stock. Correct me if I'm wrong, but doesn't Tesla rely on government state checks for being green for revenue still? But look at what this has done. Since January of this year, this has gone from $100 to $500. So on paper, it just doesn't make sense. If you were to look at Tesla's on paper, show it to any value people, like, I don't care what this company is, I would never buy it. But you ask that to some random person on the street, they're like, yeah, Elon Musk, yeah, I can invest in that. Tesla, oh yeah, they're fast. They're the leader. I don't know, where do you want your money? Do you see Tesla ever failing? And why and how? If you cannot answer that question, might be a decent place to put your money. That's the way I like looking at stuff. Not necessarily if it's going to be a growth or value. Just what could knock it off the face of the planet? I don't think anything really could. Unless he went too far into like Neuralink and said, we're not focusing on cars anymore, we're doing only Neuralink, and then it came to FDA, and FDA is like, no, we're not going to prove anything. That could be detrimental, but I don't think he'd do that. I think he's smart enough not to. Not all growth stocks are tech either, who pay a dividend of, here's an example here of Texas Pacific Land Trust. They pay a dividend of 3.35% and have a PE below most at 17.3%. So they pay a dividend. Look at what they have done in the past 10 years. 3,000%. But what has happened since March? Oof, what happened in 2019? Oof. All right, they got cut in half in 2019. They got cut below half in March. Or is this thing a growth stock? This is a nice chart here showing Berkshire Hathaway, Boeing, Microsoft, ExxonMobil, Chevron, Texas Pacific Land and Trust of compounded over the years. To see it's just blowing everything out of the water. So what do you think? Just by those numbers, is it growth? I don't know. It could still be either, right? I've talked about this before. If you don't know, Texas Pacific Land and Trust, they are a company who does basically royalty plays on land in Texas. So they own a lot of the whole west side of Texas. And what do? They lease it out, let's just call it, to oil and gas and water miners. They own water rights too. And they just charge them a percent and a money up front, or however they want to structure it, and they just take a cut. And they are super profitable. Did I mention they've got 32 employees? And they did these numbers compared to all these other ones, Microsoft and Chevron. Some companies could be debated for months on what category they might fit into. And some might just conclude they are just a true hybrid. Think this one's like a hybrid? Do you think maybe finding ones that you could consider a hybrid to be the real unicorn? Will the growth investors move to value investing after the next Hulk smash? Hulk smash, I mean when the market flies back down, when we have our next March again, it could be even worse. Do you think that the growth people, the Tesla, the Amazon people, do you think they're going to go move over to value? I think they will a little bit. They do almost every time we have a big correction, it happens. They're usually the first ones to refill. I think that's not really those people. I think that a lot of those are the value people just jumping back in. Because a lot of them just have their, market sell orders or percent off, trailing stops, wherever they just hit, and they just like, oh, buy back in. It's whatever company, they're going to be fine. As always, once they started getting outpaced by the growth, they will start saying how wrong it is to invest the way the winners are investing and how they are still very happy with their current routes. This is what the value people will usually say. Because what's going to happen, imagine if Tesla gets 60% off tomorrow. What's going to happen? It might take a week or 3, but I bet you that will pop way faster and way harder than Exxon, or some railroad company, or an electric company, or a gas company. There's gas companies that you can look at the chart where they literally are going up maybe like an 8% angle. You can keep your money in there, and you probably can totally sleep well at night on those, but can you? Because you're literally just putting money down the drain when it comes to inflation. You're losing money every year on those. So where do SPACs sit, and are they value or growth stocks? Do you care at this point? Do you just want a mixture of both? Or are you just going after the hybrid unicorns? In my eyes, all SPACs start as growth. That's kind of what a SPAC is. Massive money in, massive money going to go out. They're going to take the money, dilute, switch some stuff around. Then they are going to spend money. Why? Because they are in that growth. They need daddy's money to pop. Get some fuel lit underneath them. Most of them have non-existent PE ratios, don't you think? Yeah, I don't think any of them do, right? So of course value people are gonna if I can't see a PE ratio, if I can't even see cash flow or a PE ratio, I am not touching this. Numbers 101, they might teach you that. And there's good theory in that. But then again, if you look what a lot of companies start out at, imagine if you got into Microsoft or Amazon when it was first coming out and not cool yet. When Bezos was still sitting in his office with his hand-painted Amazon sign up on the wall. Imagine if you got to jump in then with no PE ratios. No proven product or service. Boy, a lot of SPACs definitely don't have that. As in proven on paper, real numbers. Remember, that's what the value guys are looking for. They're like, we want it proven on paper for many years with real profitable numbers before they even consider touching it. Though some can end up settling into value stocks eventually, but I don't know. Can you guys think of an example where a new brought SPAC is a value? I don't know. I don't think so. But like this is a good example of one that I think pretty darn close. It's going to be a value stock. What is this one? This is the gas station play, Haymaker acquisition that nobody's talking about. Why? Because it doesn't have a cool factor. This is going to be, they're doing some growth, right? What they're doing is they're taking money, they're going to gas stations, buying them out. They're buying ugly ones, right? And they're like, we're going to buy you out. Here's the money. Sign here. Get out of here. And then what they do is they fully remodel them. That's growth, and make them super pretty. They'll even bring in like a Subway and attach it, or McDonald's and attach it, or Dunkin' Donuts and attach it to it. Growth. And then they're really starting to make money. It'll take them a little bit of time, but I could see this one eventually getting into the value stage though, where all of a sudden people are like, okay, they kind of feel tapped out. And that can kind of happen in sectors like this, where there's basically 4 or 5 big dogs that own the whole sector, and you get to the point where there's no more mom and pops that own anything. It's just all the big 5 guys, and they ain't selling nothing, period. And that might be where they'll be like, okay, we're going to start doing dividends, and now we're going to turn into a grandpa stock, which might be fine. You know, as long as when gas stations start switching over to, you know, EV charging and all that a little bit more, for sure they're gonna be fine. A lot of people don't realize too that gas stations, they really only make money on getting people inside. You ever realize most gas stations receipt thing never works at the gas pump? Do you wonder why? It's because they want you to come inside and get it. That way you can see the hostess on the side and smell the hot dogs and see the Red Bull or in the Four Loko. All right. Like, you know what? I need some beef jerky and Four Loko if I'm gonna make it home. Did I mention they have a floor that you can buy them at? The SPACs. This is why I love them, because it de-risks the major risk in all stocks. Not even the perceived one that values supposedly have that they actually don't. But it takes away the risk as long as you buy the commons. So it's, as far as I know, the only way you can buy into a high growth stock with a floor and almost zero risk. You realize how crazy of an investment that is? And people still don't get it. People still don't watch my videos until it's already been 2 weeks after the SPAC has come out with the LOI. And then people are FOMOing in once it gets to 15. Then they're like, okay, now I heard about it. Now I got to buy in. Watch them. Go watch my videos that aren't cool yet. Go watch ones with the least amount of views. Those are the ones you need to be in right now. Why? Because they're still cheap. There's like almost zero risk. It's everyone's opinion. What do you think? Did I just confuse everybody? I hope not. At the end of the day, we could speculate for weeks and weeks and weeks, even on just one stock, whether it's a true value or a true growth. It's just kind of a way to look at them and try to keep your mind inside either one, or maybe try to keep it in the middle where you can find a unicorn in the middle. Do you guys know any unicorns? I think TPL might be one. Are SPACs unicorns? Are they kind of in the middle? I think so. There's multiple reasons I like SPACs. They also have even the cool factors, right? They have the cool team, the cool people hyping it. That's why I'm big on SPACs. Just some of the reasons. What do y'all think? Any more plays that you guys want me to take a look at? Any other videos you want me to do? Just put them down in the comments. Let me know. If you want to spark conversation, have any more questions about this, or you think I'm wrong about one of the ones I mentioned as a growth or a value, or maybe I contradicted myself about Mr. Buffett, or maybe he contradicted himself. I just said it out there. I don't know. Let me know down in the comments. If you wouldn't mind subscribing, please do it. It definitely helps out the channel. Please like this and share this with your friends. Y'all take care and have a good day. Did you know that we give away free silver? Simply leave a comment on the video, and as long as you're in the continental United States, you can be automatically entered to win. Please friend us on Twitter and StockTwits.